looking forward, is this a sign of a coming end of the business cycle, a recession, a bear market, or is it a buying opportunity? And so we're going to want to talk about that. But if we're going to talk about forecasting, I thought maybe I would first let you in on some techniques, forecasting techniques used in the investment industry, sort of tricks of the trade. So the first one I'm going to show you, this is a quote from Harry Truman. He says, "Give me a one-handed economist. All my economists say on the one hand and the other." And it's true. You can say, well, interest rates are going up, but on the other hand, maybe they're going to go down. So the other one is a version of this, and it comes from the anchorman, Brian Fantani. He says, 60% of the time it works, every time. Now, the Wall Street version of this, it's not 60%, it's 40%. And what I mean by that is that if I have a forecast that's non-consensus, but I still want to go out with, I'll put a 40% probability on it. Because if it works out, I get full credit. You're going to forget I only said 40%. But if it doesn't turn out, well, that wasn't my main probability. It only was 40%. So I win either way. Now, in fairness, for forecasting, it's hard. And I think it's particularly hard in this environment. There are a lot of different factors influencing the economy and the markets, and a lot of different routes we could take. We thought tonight, in order to show that, we construct it like a roadmap, like an old-style map you'd have. Unfortunately, I brought this idea up to the team, and because there are a bunch of Gen Xers and millennials, they'd never even heard of a roadmap before. So what we decided is we're going to create a GPS, an investment GPS. So this is what a standard GPS looks like. This is the route that we took to get here tonight from the office at Broadway and Granville down to the Fairmont. This is what our GPS looks like. So it's similar. You have a starting and an end point. But what this really is, it's a chart of the business cycle. So if I put in a timeline, and then the y-axis, I have the maximum sustainable output of the economy, which is the amount the economy can grow without overheating and creating inflation. According to the Federal Reserve, that's about 1.8%. So if we move from left to right on this business cycle, you can see you start off the economy going below that sustainable rate. You're in recession. The central banks are cutting interest rates to stimulate the economy. So you have interest rates going down and inflation going down. The economy bottoms, and now you start have interest rates level off. It's still, you have the economy starting to recover till you get to that sustainable level, and now you start to see inflation and higher interest rates. Until finally, the economy rolls over and you start the cycle again. And you have stagflation because you still have high inflation as that hasn't quite caught up. So where in this cycle are we right now? Well, if we look at this next chart, which is showing the output gap in the U.S. economy. So those gray bars are where the U.S. economy has been in recession. The red line is the output gap. And traditionally, you see every time the output gap has been eliminated, when it goes to zero, 12 to 24 months later, the U.S. has gone into recession. And you can see on the far right, about November of last year, the output gap wasn't eliminated. So with that, we look at it, and it's not very precise. We're saying 12 to 24 months, historically, you would have a recession. So if we look at our GPS, we can sort of get a bearing of where we are. We think we're somewhere between here and the top of the cycle. Now, that's not a bad thing. For a long time, we were parked, stalled down here with low inflation and low growth. So we're now moving again, which is the good news. The bad news is, again, as we move above that sustainable level, we're now incurring inflation and higher interest rates, which is bad. But I would maintain that this area here is actually a very good environment for risk assets. And what do I mean by that? Well, if we look on the left, the bar charts is showing different buckets of inflation and the corresponding valuation. And you can see from 0 to 2% inflation, it has the highest historical valuation. And we're right now at the very upper end of that range, around 2% inflation. And even if we were to move a little bit higher, it's the second highest valuation bucket. So at these levels, inflation isn't really hurting valuations. It's the same for interest rates. On the right, you can see that positive correlation between valuations and 10-year bond yields to an inflection point of about 5% historically. So as long as the 10-year US bonds are below 5%, you get a positive correlation with interest rates and valuations. Now, some people will say the economy has structurally changed, so it's not 5% where you have that inflection point, but it's more like 3.5%. Even if that's true, 10-year bonds today were around 2.82%, so we're still well below that. So inflation and interest rates right now aren't weighing on valuations. But still, we want to know, when are we getting to the end of the road as far as the economy goes? When are we looking at that recession? 12 to 24 months is quite a band. So let's refine it a bit, and we built in 3 other indicators into our GPS. And the first one is the shape of the yield curve. So again, those gray bars, that's when the US has gone into recession. That blue line is the shape of the yield curve, such that when the blue line is going down, it means short rates are rising faster than long rates. 2-year yields going up more than 10-year yields. When it goes below 0, it means the yield curve has inverted, and which is an unusual situation. And you can see every time the yield curve has inverted, we've had a recession. Or to be more precise, every time we've had a recession, it's been preceded by an inverted yield curve. Now, as we pointed out before, yes, the yield curve has flattened, but we're still not near to having an inverted yield curve. So the yield curve indicator is telling us that we have time before the next recession. Let's take a step back. What causes the central banks to raise interest rates, to tighten monetary policy? Well, inflation is the key variable they look at. And you can see from this graph, again, those gray bars are when we've had a recession in the US. The blue line is wage growth. And typically, you can see that you don't get a recession until wage growth hits 4%. Right now, we're quite a ways from that. Right now, wage growth in the US is around 2.7%. So we don't see inflation being that indicator to having a recession in the US. The other thing we would look at is, when are higher interest rates starting to really have an impact on the economy in companies? And one indicator that shows that is credit spreads. So it's the amount of interest a company has to pay above the risk-free government yield. And you can see, again, those gray bars when you have recession, you can see the credit spreads typically will move up before that recession. And on the right, you can see credit spreads have actually been quite stable and at a very low rate. So again, we don't see credit spreads as being an issue in this environment. Now, as you can see from this cartoon, there are 2 punch bowls, quantitative easing and interest rates. Eventually, interest rates are going to start to move up, and that punch bowl will be taken away. But as you can see on the right here, someone's brought a new punch bowl to the party, and it's called fiscal policy, or what that really is referring to is US tax reform that was passed late last year. US is cutting its corporate tax rate from 35% to 21%, but that's going to help corporate earnings. But the real story on what it can do to the economy is productivity growth. Because US corporations have about $2.6 trillion overseas that they can now bring back to the US and invest. And they have an added incentive to do that, because for the next 5 years, they can fully expense any business investment. If they put this into productive projects, it could lead to higher productivity growth. So what does this look like on our GPS? Well, let's bring it up again. You can see that 1.8%. It's not a static number. So GDP growth is the addition of population growth plus productivity growth. Population growth is stagnant at about 0.5%, but productivity growth can move higher. And if we get more productivity spending or in projects that increase productivity, that line can shift up. And McKinsey and Company has estimated you could have an increase of about 1.5%. So what does that do to our GPS? Well, the whole curve moves up, such that before we thought that sweet spot for the markets was like this. Now it's more like that. So rather than thinking we're maybe at the end of the business cycle, we could be closer to the beginning. Now, if that's going to extend the cycle, this cartoon indicates what could shorten it. And this is the bull market saying to Donald Trump, "We got a good thing going here, Don. Don't mess it up." And what he's referring, and what this cartoon was really referring to, was the first one on my list, which is a trade war with China. But we know there are a lot of other issues that are impacting, and are revolving around the Trump administration. And we've forgotten all about North Korea. You have, we had on the weekend missile strikes in Syria. We have, issues in the Middle East. We have the Mueller investigation that, could result in an impeachment of President Trump. Stormy Daniels, and quite frankly, we don't know what's going to come in tomorrow's headlines, but this could all impact, the markets. And one thing I would like to point out, it's not, especially the trade wars, it's not that we think Trump is wrong on everything. In fact, Thomas Friedman had a good article in the New York Times with the quote saying, just because Trump says it doesn't mean it's not true. We take it for granted. But I would point out the problem is the style of the administration and the uncertainty and unpredictable nature of that. If you're a company and you're looking to invest hundreds of millions of dollars in this kind of environment, it's hard. So if those companies hold off on those projects, that productivity gain that we thought we would get, we might not get. So that would be a negative for the economy.